Hello and welcome to Stoxies. Today, we take a look at the stock market performance in November 2025. This month was characterized by high volatility, especially in technology AI stocks, but also by reshuffles in sectors such as pharmaceuticals, minerals, energy, logistics, and more. We'll see which sectors plunged, which rose, which stocks stood out, and what this means for investors. November was a month that tested the patience of investors internationally. Markets started the month with nervousness and increased volatility, as there were strong concerns about the course of the global economy, inflation, and the cost of financing for businesses. This created pressure on many indices and led to falls in several stocks, even in companies that had previously shown excellent performance. The technology sector was the most characteristic. After years of continuous growth and after the impressive explosion of artificial intelligence and companies related to this sector, November brought a significant correction. Many companies that had seen their share values increase very quickly were faced with liquidations and falls. This does not mean that technology lost its momentum. On the contrary, the correction showed that the market is now turning to more balanced options, rewarding companies with real revenues and not just promises. Although there were significant losses, the sector also showed signs of resistance, mainly in companies that have a strategic position in infrastructure, security, and cloud systems. Let's start with the tech sector with Nvidia. November was a month of tension and upheaval for Nvidia. The stock started the month on a positive note, along with other tech stocks, as the market was still bullish on the AI pandemic. But as the month progressed, the pressures intensified. General uncertainty about interest rates, a slowdown in some of the massive AI investments, and deflationary hype led to a decline. On November 13th, Nvidia stock fell 3.6% in one day, in part due to massive liquidations in the tech sector. Despite these pressures, news came in the middle of the month that brought a temporary recovery. The company reported strong third-quarter results, with revenue above estimates and strong demand for its AI chips. That gave investors hope that despite the uncertainty, Nvidia's core business and market position remained strong. But November also brought new concerns. The rise of competitors, companies trying to build their own AI chips, began to short-circuit Nvidia's monopoly. In addition, many investors became more cautious. Earnings seem to have built in a lot of expectations, and the upward trajectory may have exceeded logic. For an investor, November was a reminder that Nvidia stock is not a sure bet. It is strong and promising, but not without risk. If you're thinking about investing now, it's a good idea to be patient, expect potential fluctuations, and be prepared for reshuffles, especially as the AI landscape changes. In short, November didn't kill Nvidia. It just reminded us that even the hottest stocks require patience. AMD. November was a defining month for AMD, full of big swings, hopes, and reality. It started with the company reporting excellent results. For the third quarter of 2025, it announced record revenue, about $9.2 billion, and strong profitability. The market, therefore, had every reason to see AMD as one of the big bets in the semiconductor and artificial intelligence space. A few days later, on November 11th, AMD organized its 2025 Financial Analyst Day, presenting ambitious goals for the next 3 years, with an emphasis on the development of the data center, AI division, and the launch of new GPU, CPU products. This announcement gave the stock a new boost. In the early weeks following the presentation, shares rallied significantly, as many investors saw AMD as a strong competitor in the field of artificial intelligence. However, the momentum did not last. The stock faced strong pressures. Demand for hype around AI began to be liquidated, while markets became more cautious due to a broader climate of uncertainty. During the month, AMD recorded a decline that at times led it to have one of its worst months in recent years. Despite this decline, AMD did not collapse. The company continues to have technological capability and realistic prospects. with new products, design, and strategy in the data center and AI space. That means someone looking for a long-term investment might see the current price as a bargain, especially if they believe in the growth of artificial intelligence and a more competitive chip industry. For the average or new investor, AMD's November is a reminder that tech stocks, especially those related to AI, are highly sensitive to expectations. Good news and big deals can drive a rally, but any doubts, competition, or a change in market sentiment can quickly wipe out gains. In short, AMD looks capable. It's risky, but it could be worth watching, provided you're prepared for the changes. Oracle. November was a month of sharp fluctuations and market uncertainty for Oracle. The stock started the month on a solid note, but concerns about the company's cloud and artificial intelligence strategy soon began to weigh on its price. Investors began to take a closer look at Oracle's ambitious plans for AI, and the confidence that had previously been there began to cool. The company also faced rising infrastructure and capital expenditures, which raised doubts about its ability to maintain profit margins in the cloud. At the same time, its reliance on large contracts with a few customers creates additional risk, as any delays or problems in those deals could significantly impact revenue. The market responded by sending the stock lower, signaling that sentiment around the company is being driven by both data and expectations around AI. Despite the pressure, Oracle remains strong in terms of technology and infrastructure. The company continues to close significant deals and grow its cloud and AI platform, which maintains its medium and long-term prospects. For an investor who looks beyond short-term fluctuations, the current decline can be an opportunity, provided that he is prepared to deal with increased volatility. November reminded that Oracle, like many large technology companies, is not just a safe stock. Its success depends on the ability to make large investments in infrastructure and AI, effectively manage costs, and maintain customer trust. However, the company has a strong customer base and expertise that could pay off significantly in the future. For the average or new investor, the message is clear. Oracle offers potential upside, but with high risk and volatility. Fundamental analysis, patience, and market understanding are essential to capitalize on potential opportunities. The current decline does not mean that the company has lost its momentum, but that strategy and composure are required to benefit from market fluctuations. Supermicro. November was one of Supermicro's toughest months. Despite the company's operations in cloud infrastructure, AI, and servers, sectors that are now considered the center of technology, the stock saw a big drop. According to major technology company lists, Supermicro stood out as the worst performer of the month, down nearly 37%. The reason for the drop was the company's financial results and forecasts for the near future. In the announcement for the first quarter of 2026, revenue fell significantly, below expectations, and net profitability sank. The market responded with a massive sell-off, as many investors seem to lose confidence in Supermicro's ability to meet the high demand for AI servers without sacrificing profit margins. Beyond the numbers, the pressure also came from the general turmoil in the technology sector. Investors appear more wary of companies that are betting on AI hype. Supermicro, despite its position as an AI infrastructure manufacturer, failed to stand out this time, and the price decline was sharp. However, it is not all negative. The company continues to have expertise and strives to innovate. It recently introduced new high-performance server solutions with an emphasis on GPUs, and announced that AI platforms are an important part of its structures. That means if demand for AI infrastructure comes back strong, or if the company can reduce costs, there's a chance of a rebound. For an investor who isn't afraid of volatility, the stock's current dip could be seen as an opportunity. The price is well below its year-to-date highs, and if Supermicro stabilizes, the upside is significant. But that requires patience and caution. The company remains vulnerable to large swings. November taught Supermicro an important lesson. AI server companies are not safe bets. Demand may be strong, but profit margins, cost management, and delivery delays can tip the balance. To invest or stay requires careful assessment and understanding of the risks. Palantir. November started out on a relatively upbeat note for Palantir. The company reported quarterly results that looked great on paper. US commercial business grew 77% year-over-year, earnings per share beat estimates, and management raised its 2025 revenue guidance. Despite the positive data, the market reaction was harsh. The day after the announcement, the stock fell 7% to 8%. The decline was not an isolated one. The first week of November brought a total drop of 14% to 15% for Palantir, as many investors took profits after the sharp rise in previous months. The reasons beyond profit-taking were growing concerns about the company's valuation. Many felt that the stock had already built into its price expectations that might not materialize, especially in an industry, artificial intelligence, that is now showing signs of fatigue. There were attempts at a recovery throughout the month. Around November 24th, Palantir gained 6.5% as part of a broader tech rally, supported by expectations that a potential interest rate cut and renewed interest in AI would boost companies in the space. However, this proved to be temporary. The overall performance for the month is down, with the stock losing a significant percentage of its highs, making November one of Palantir's worst months since 2023. It's worth noting that the decline is not due to the company's failure to deliver financially. The numbers show rising revenue, profitability, and contracts. The problem lies in the gap between expectations and reality, i.e., how high the stock had been built before the announcements. When investors realized that even the best results can't justify the exorbitant prices, they started to liquidate. For an investor with a medium to long-term view, Palantir's November drop could be seen as a correction and possibly an opportunity, especially if they believe in the future momentum of artificial intelligence and the company's ability to turn its contracts into steady income. However, it is not a low-risk stock. The volatility is high, and the valuation remains controversial. Ultimately, November for Palantir was recorded not as a tragedy, but as a reality check, a reminder that in an industry like AI, investing requires patience, realism, and caution, and that demand and hype alone are not enough to sustain a stock market rally. Microsoft. November saw Microsoft in a period of reshuffle. The company, which in recent years has emerged as a major player in artificial intelligence and the cloud, continues to aggressively target these areas. Recent results showed that its cloud and AI services remain important, which shows that Microsoft is not abandoning innovation and growth. Despite the positive fundamentals, strong cloud revenue, and continued investments, the market appeared more cautious. A day earlier in November, the stock fell significantly. This was due in part to investors' fears that large spending on artificial intelligence infrastructure may not pay off immediately. Pressure on the broader technology sector made the sell-off easier, and Microsoft did not shy away from this capital outflow. At the same time, the company announced new, ambitious investments in AI infrastructure on a global level. For example, it has planned a multi-billion-dollar investment to expand its artificial intelligence and cloud services in markets like the United Arab Emirates. This shows that its strategy remains long-term oriented, even if it means short-term volatility. So, the situation for the investor looks like a balance between opportunity and risk. On the one hand, Microsoft has expertise, infrastructure, and significant cloud and AI revenues, things that could pay off especially well if global demand for AI services continues to grow. On the other hand, large investments take time to reveal their results. This means that the stock can be highly volatile, and anyone investing now should be prepared for fluctuations. Ultimately, November for Microsoft was neither a disappointment nor a complete success. It was a month that reminded us that even tech giants don't have better guarantees, but the foundations are there. And for anyone with patience and a long-term approach, there can be significant rewards. Alphabet. In November, Alphabet stock was one of the best performers among big tech stocks, as the company embarked on a new growth cycle driven by artificial intelligence and cloud infrastructure. The big jump came when Alphabet unveiled its new AI model, Gemini 3, a big name that garnered market attention and boosted confidence in the company's future. The company also got a boost when Berkshire Hathaway revealed it has a significant stake in Alphabet, which for many investors was a vote of confidence at a time when AI investments are both hopeful and uncertain. The company's fundamentals also fueled optimism. Recent quarterly revenue topped $100 billion, while cloud, and specifically AI cloud infrastructure, saw significant growth. Management is optimistic and investing on this momentum, aiming to capitalize on the growing demand for AI and data center services. But, as is often the case with big games, the uptrend has not come without caveats. The stock price is considered by many to be high based on technical data, with indicators indicating a possible overbought, meaning that the rally may have discounted much of expectations. This means that, for a new or average investor, Alphabet could represent an opportunity, but with caution. On the one hand, it ticks many of the boxes: innovation, technology, large cap, and strategic vision for AI and the cloud. On the other, it requires patience and being ready for fluctuations if expectations don't materialize immediately or if the market prices more conservatively. Ultimately, November 2025 served as confirmation for Alphabet that, for now at least, its AI strategy is paying off. But it also reminded us that in a rapidly changing industry, value is not measured by hype alone, but by realism, execution, and the ability to respond to the market. November was a pretty tumultuous month for Meta. It started with the company announcing strong earnings. The third quarter of 2025 saw revenue growth of 26% year over year, and its advertising business showed signs of momentum, but the joy was short-lived. Then came the announcements of significant investments. Meta raised its capital spending estimates to $70 billion to $72 billion in 2025, mostly for AI infrastructure and data centers, and warned that even more spending increases were expected in 2026. At the same time, we saw an accounting surprise. The stock was hit by a large non-cash tax charge, causing GAAP net income to fall significantly, and earnings per share to be much lower than expected. All of this led to an investor exodus and a price drop. Meta's stock has lost a significant amount of its value in the month, as many saw the relentless increase in expenses as a sign that the valuation was overvalued and that the risk had increased. However, the company's core business shows that it remains strong. Its focus on AI, its huge user base, its advertising presence, and its traditional weapons, all of these have not disappeared. For some investors, the stock's decline may be an opportunity to enter, given that Meta is positioning itself as a major player in the medium to long-term future of artificial intelligence and digital advertising. However, the risk has not disappeared. The heavy reliance on big AI infrastructure spending means caution is needed. Potential delays in implementation, a drop in advertising demand, or disappointing results from new products could weigh on the stock. For a casual or new investor, Meta's November story is a lesson. Big companies, huge ambitions, and innovations don't automatically mean stability or profits. Patience, realism, and an understanding of risk are required. If you're thinking about investing now, be prepared for volatility, but also potential upside in the long term. November started on a positive note for Amazon. The company reported strong growth in its cloud division, Amazon Web Services, with revenue up about 20% in the third quarter, which renewed investor confidence that Amazon is a leader in providing cloud and AI infrastructure. This news, along with expectations of strong sales ahead of Black Friday and the holidays, and Amazon's already strong presence in e-commerce and AI infrastructure support, gave the stock a boost. However, as the month progressed, the stock price failed to hold on to its gains. On November 26, the stock closed around $229, down 10.3% for the month. The decline is due to a mix of factors: concerns about a broader correction in the tech and AI sectors, doubts about whether large infrastructure and expansion spending can translate into profits, and fears about potential pressure on profit margins. Despite the decline, Amazon has not completely lost its momentum. Its strategy to rely on cloud, AI, logistics, and retail shows that it is not a one-legged stool. AWS remains a significant growth driver, and the holiday season with Black Friday and Cyber Monday offers the possibility of increased sales, which could support the stock if the numbers confirm expectations. For an investor with a medium or long-term view, November can be seen as a period of adjustment. The stock had risen quite a bit, perhaps more than the fundamentals justified, and the correction was partly natural. If Amazon can stabilize AWS revenue, take advantage of holiday risk, and control costs, the current price could be considered a bargain. What investors should keep in mind is that Amazon, like other technology and infrastructure companies, is subject to significant volatility. The combination of retail with cloud and AI brings great potential, but also risk. If AI cloud expectations are not met or spending proves excessive, the stock could come under renewed pressure. Ultimately, November didn't kill Amazon, but it did serve as a reminder that great companies need great execution, patience, and a balance between ambition and financials to justify their price. Tesla stock has been through a turbulent month in November, with a high degree of uncertainty and moments of optimism. The company continues to be at the center of the market, not only as an electric car manufacturer, but also as a player in the fields of artificial intelligence, autonomy, chips, and robotics. This means that the expectations surrounding Tesla are currently very complex and multifaceted. On the one hand, there were positive signs. Tesla announced that some analysts had upgraded their target prices for the stock, considering that in the long term, the company has important weapons, chips, software, autonomy technology, and future robotics projects. These expectations led to moments of growth. On news related to new investments, new chips, or even indicatively positive sentiment from markets and analysts, the stock managed to recover temporarily. However, the thoughts behind the hype had an effect. November showed how fragile Tesla's valuation can be when reality, sales, profits, costs, collides with inflated expectations. According to reports, the company saw its profits fall significantly while profit margins fell and operating expenses rose. In addition, delivery problems, competition in Europe, and a decline in demand are creating additional pressures on the stock. Tesla's shift from simply a car manufacturer to a player in AI, robotics, and infrastructure technology offers strong upside, but it also greatly increases the risks. The market now seems much more selective. Every announcement of delays, every deviation from expectations, every normality in the competition has a greater impact on the price. This made November more volatile, with large fluctuations, positive and negative. For an investor today, Tesla's case looks like a balance between opportunity and probability. If he believes that autonomous, robotics, chip, and AI projects are not just a fad, but a long-term change. And if he has patience, tolerance for volatility, and is not afraid of potential corrections, then the current price may offer an entry with strong upside. But if he is not patient or does not want a lot of uncertainty, Tesla is not a safe choice. November showed that what they say is even more true for Tesla. The greater the innovation, the greater the risk. The company remains a major player and has significant weapons. But success is not a given. It requires time, execution, and the ability to withstand market fluctuations. In November 2025, Broadcom stock stood out in the technology market, and for good reason. The company, a manufacturer of semiconductors and networking cloud infrastructure, managed to take full advantage of the increased demand for products related to artificial intelligence, cloud infrastructure, and data centers. During the month, the stock hit a new all-time high. The 386.50 peak shows that the market trusts the company's business model and prospects. In many sessions, the price moved up. And when there was news of partnerships in AI, the market reaction was immediate and strong. Despite the pressure in the broader technology environment, Broadcom shows that it is not relying solely on momentum. According to data, the company has significant profit margins and operational stability, characteristics that offer a safer pillar in the midst of market volatility. Moreover, Broadcom is not just a chip player. Its expansion into cloud infrastructure, networking, storage, and enterprise software and services gives it a broader base, which reduces the risk of being dependent on just one market. On the other hand, as with any stock that has already risen sharply, there is also risk. Prices are high, and an estimate that the AI market will continue to run is not certain. If there is a downturn in demand for AI infrastructure, or if profit margins decrease, which could happen if competition increases or requirements change, then the pressure on the stock could be significant. For an investor today, Broadcom looks like one of the interesting options among mid-cap tech companies. It offers potential upside, has a wide range of activities, and seems to be not just relying on hype. If you think in the medium to long term, with patience, and if you believe that the market for AI cloud infrastructure will continue to grow, Broadcom could be a solid shot. As technology came under increasing pressure, a large portion of investors turned to other sectors that are considered more stable and less vulnerable to climate change. One such sector is the healthcare sector. We start with Eli Lilly, where November was a milestone month. The company managed to become the first pharmaceutical company in the world to enter the $1 trillion club in valuation, which clearly shows how much investor confidence has skyrocketed in it. The main reason behind this rise is the huge success of Eli Lilly's drugs for obesity and diabetes. Sales of these treatments skyrocketed in 2025, now covering a large part of the company's revenue. At the same time, Eli Lilly announced that a new obesity drug is on the horizon, which in recent trials showed significant weight loss rates. This has raised expectations for the company's future even more. Analysts are confident. A recent rating agency upgrade to the stock was based on the assessment that Eli Lilly faces multiple waves of adoption of obesity treatments, meaning this is not a temporary wave, but a long-term trend. Of course, there is no shortage of issues that need attention. Eli Lilly's agreement with the US government on the pricing of obesity drugs, with a premium price for some patients, could reduce profit margins in the long term. Moreover, as with any pharmaceutical company that invests heavily in its pipeline, there is risk. If some of the new treatments fail or are delayed, investors could punish the stock. For an investor today, Eli Lilly is one of the heavyweights of the healthcare sector, with strong fundamentals, huge demand for its products, and ambitions to expand into new markets and drugs. If you look at the medium or long term and assess risks wisely, the stock has significant upside. If you want something safer, it's not a financial haven, but with caution it can be rewarding. AbbVie attracted investor interest in November as it went through a period of transition with significant developments in its core products. The company continued to rely on sales of its core medicines while investing aggressively in new therapies to reduce its reliance on single-agent products. This was particularly important as AbbVie had been under pressure in recent years due to the gradual expiration of patents on major commercial drugs. The company's results in November left a positive mark, as sales in specific therapeutic categories moved upwards. Announcements of progress in the research and development of new drugs raised expectations that AbbVie can strengthen its position in high-demand markets, such as immunology, neurology, and oncology. Investors seemed to respond positively to this prospect, as the company presented a strategic plan to strengthen its revenues in the coming years. Despite the positive data, AbbVie's stock was not unaffected by the general volatility of the industry. The pharmaceutical market remains demanding, with competition around new treatments and ongoing pressure from pricing regulations. However, AbbVie seems to have adapted to this environment, maintaining a strong financial base and a steady growth path. Overall, November was a month in which AbbVie showed that it can maintain a dynamic presence in the healthcare sector. With a combination of new investments, research, and strategic moves, the company continued to strengthen its profile as one of the most important players in the pharmaceutical industry. The coming months will determine whether this steady course will turn into even greater growth and whether the positive expectations of the market will be confirmed. Merck had a particularly eventful November, as developments around its core pharmaceuticals and research continued to drive investor interest. The company continued to strengthen its position in categories where it is already established, such as cancer and immunology. Demand for its top-of-the-line products remained strong, which was a stabilizing factor for its stock market performance. At the same time, Merck made moves that demonstrate a long-term growth strategy. Investments in research and testing of new drugs underscored the company's intention to remain at the top of the pharmaceutical industry. The production and commercialization of new therapies was hotly debated by the market, as many investors awaited indications of whether the next generations of drugs would continue the successful course of the company's already known formulations. However, like the healthcare industry as a whole, Merck did not avoid pressure from competition and the pricing environment. Government regulations and negotiations around drug prices remain an issue that creates volatility. However, its financial base and the diversity of its portfolio are important advantages, which help the stock maintain a stable image. Overall, November confirmed that Merck continues on a stable and predictable path. The company has a strong presence in high-demand therapies, promotes new drugs, and invests in the development of health technology. For investors, Merck remains one of the most reliable and proven groups in the pharmaceutical space, with prospects based on both stability and continuous innovation. Johnson & Johnson had a solid and significant November, with developments in its pharmaceutical and medical sectors continuing to strengthen its position in the market. The company showed that it can maintain a strong presence in various categories of healthcare products, from medicines to medical devices. Sales of basic products remained at satisfactory levels, supporting the company's overall image on the stock market. In this month, J&J continued to focus on new therapies and areas with dynamic growth. Research on drugs for chronic diseases, as well as investments in advanced health technologies, focused investors' interest on its future prospects. At the same time, the company presented moves that underlined its intention to further strengthen its product portfolio and open up new areas of growth. Johnson & Johnson's share continued to be affected by the factors that characterize the industry as a whole. Competition, ongoing price pressure, and regulatory constraints remain challenges that test not only the company, but also the entire industry. However, J&J has the advantage of its strong financial base, long history, and diversity of its activities. Overall, November highlighted J&J's ability to maintain a steady course even in times of uncertainty. The company remains one of the most stable and reliable groups in the healthcare sector, with deep expertise, strong research activity, and prospects based on years of experience and innovation. For investors, it remains a choice with stability and a long-term perspective. And now for gold. Gold has been in the spotlight again recently. Its price continued its upward trend in November, as many investors see it as a safe haven during times of economic uncertainty. When the global market is turbulent, gold often strengthens, because it is considered a stable value that maintains its purchasing power even when other forms of investment are under pressure. One of the main reasons that led the price of gold to rise is concerns about the course of the economy and the constant change in interest rates. In periods where there are fears of a recession or a decline in other investments, gold gains ground. In addition, the weakness of the dollar in many phases of the year strengthens its price even more, as demand for the precious metal increases. Despite its upward trend, gold is not an investment without changes. Its value can be affected by sudden developments in the economy, changes in central bank decisions, or the strengthening of major currencies. This means that although it is considered more stable than other options, it requires caution and patience from those who choose to invest in it. However, gold has proven many times over the years that it can act as a protection against crises. For those interested in investing with a long-term view, it is an option that can offer security and potential returns. Its course in the coming months will depend on the climate in the markets and on decisions at the economic level. The only thing that is certain is that it continues to be an important indicator of how investors react to changes in the global economy. Now let's move on to crypto. The price of Bitcoin in November fluctuated sharply. At the beginning of the month, it was at very high levels and exceeded $100,000, showing that demand was strong and investor interest was increasing. However, this picture did not last long. During the month, the price showed a significant correction. In several periods, November was characterized by continuous falls, with the value of Bitcoin gradually falling towards lower prices. The market showed that it remains sensitive to climate changes and concerns about the economy. Many investors acted cautiously, which increased the pressure on the price. Towards the end of the month, there was an attempt at recovery. Although the rise did not return Bitcoin to previous levels, it managed to contain losses and stabilize at higher prices than the lows of the middle of the month. This shows that the market maintains its momentum, but also that Bitcoin continues to be directly influenced by the prevailing economic climate and investor sentiment. November showed once again that Bitcoin does not follow a stable path. It may be rising sharply, but at the same time, sharp corrections are possible. It remains an investment that requires patience, knowledge, and careful study, as changes in its price can be abrupt and intense. In closing, November was not a month to be afraid of. It was a month that provided valuable information. It showed that the market never operates in a one-dimensional way. Some sectors were pressured, others rose, and others remained stable. And that is exactly what creates opportunities. Investing is not a game of chance. It is a process that requires understanding risk, choosing the right positions, and a long-term view. Those who think strategically use these months to their advantage. The rest are simply afraid of them. Thank you for staying until the end of the video. If you liked our analysis of the main market news for the month of November, like the video, subscribe to our channel, and press the bell to receive notifications about our new videos.